that's kind of simply how it works. Fannie and Freddie are buying these loans from banks so that they can, keep the wheel turning and keep getting qualified folks their mortgages.
Hello, and welcome to this episode of Let Me Ask You This, brought to you by the California Association of Realtors. My name is Matt Roberts. I'm the CAR Federal and Local Government Affairs Director. And joining me, as always, is my colleague Mike Falk, CAR's Public Policy Economist. And Mike, this week we want to talk about an issue that has been in the headlines, Fannie Mae, Freddie Mac, and whether or not they should or shouldn't come out of conservatorship and how maybe they should come out of conservatorship. But more importantly, I'm not sure everybody understands what Fannie Mae and Freddie Mac are.
Yeah, it's kind of like Fannie Mae, Freddie Mac. They are one of the cornerstones, one of the foundations of not only, the real estate industry and housing in America, but all sorts of different financial markets. And yet, I feel like most people don't totally understand what they do. I think that when you talk about them, you get a lot of nods and smiles, and you can almost sense like people are hoping you move on. But so, I guess for our listeners, if you had to distill, like I don't know what a Scotch metaphor is, but a very good proof, you had to distill it all the way down to the most basic level, what Fannie Mae and Freddie Mac do. How would you describe that?
Yeah, I think for consumers, for home buyers, which is really the only reason Fannie and Freddie exist, Fannie and Freddie, they make sure that when a buyer walks into a bank to get a mortgage, the bank has money. And that's it. Nothing more. Now, there's a ton of reasons why the bank has money because of what Fannie and Freddie do. But if you have a qualified home buyer, when they walk into a bank, they will always have money to make a mortgage. And that's it. And that's really kind of a foundational piece of America's mortgage market. So, Mike, let me ask you this. Now that we know the purpose of Fannie and Freddie is to ensure that lenders have money to make loans, how do they do that? Because nobody is going directly to Fannie and Freddie and borrowing money from them, at least the home buyers. So how is it that Fannie and Freddie ensure that you, Mike Falk, can walk into Acme Bank or ABC Lender, and as long as you're qualified for the mortgage, they've got money?
Yeah, so let's talk about this kind of in a really basic way. If I lend you $50 and you take it, I don't have that $50 anymore, right?
Right.
But if there were an outside group that bought that loan, then I would have $50 to lend to someone else. And, that's kind of simply how it works. Fannie and Freddie are buying these loans from banks so that they can, keep the wheel turning and keep getting qualified folks their mortgages.
Okay, so Mike Falk walks into a bank, borrows $500,000 for a mortgage. Right. The bank is now out that $500,000. Correct. It's $500,000 less to loan. And what you're saying is that Fannie Mae and Freddie Mac, they come along to the bank and they say, we want to buy that loan.
Correct.
Here's $500,000. Fannie and Freddie buy the loan, and now the bank has the $500,000 to make another loan. Correct?
Right. Yeah. Yeah.
As simple as it gets.
Yeah. It's just, keep her moving.
All right. So, Mike, let me ask you this. We talked about, the role that Fannie Mae and Freddie Mac play in the mortgage market and ensuring that banks always have money to lend out. Besides the obvious that, the banks have money and make to make mortgages. Right. What other benefits are there to the consumer by having Fannie Mae and Freddie Mac?
Well, I think that the one thing you're going to want to take away from here is stability. Stability. these
Yep.
banks know that there's an entity out there, I mean, Fannie and Freddie, that are going to buy these loans. If there was any uncertainty about that, or where that, whether they'd be able to make these loans, you can expect interest rates to go up. I mean, uncertainty with large sums of money equals higher interest rates. That's just, that is life. If you've ever been to a bookie like me, you can understand, you see that 18% thing and they look at you sideways, I'm joking. But
I like the fact that you just copped to a felony on video.
I know, I was joking. But no,
disclaimer. The one last thing I would add, the loans that Fannie and Freddie can buy, they have to be underwritten in a way that conform to Fannie and Freddie guidelines.
Mm-hmm.
So Fannie and Freddie are not out there buying just any mortgage that gets made.
That's right.
The loan has to be below a certain amount. The loan has to have certain FICO scores, credit scores. They have to have a certain loan to value, certain down payment, as well as perhaps mortgage insurance. The point is that it's not just any mortgage being made and Fannie's happy to walk in and buy it. No, they're very strict underwriting guidelines. And so it's important that people understand that these are qualified buyers, these are conforming mortgages, and they're incredibly safe and well underwritten. All right, thanks for joining us on this episode of talking about Fannie Mae and Freddie Mac. Hopefully, if you enjoyed this, you'll look forward to our future episodes where we go into more detail on Fannie Mae and Freddie and what they do, the role they play, and why it's vital that whatever the administration or Congress does to take them out of conservatorship is done in a way that really protects consumers in the mortgage market. So thank you again. And Deanne, good luck editing this, and we'll see you next time.
See you later.